Hello, and welcome to the webcast, FASB Update for Private Companies and Not-for-Profit Organizations. Thanks for being with us today. Please note that the views expressed in this webcast are those of the individual presenters. Official positions of the FASB are reached only after extensive due process and deliberations. Next slide. My name is Jennifer Weiss. I'm a Supervising Project Manager and Coordinator of the Private Company Council. Presenters on today's webcast include FASB member Joyce Joseph, FASB Technical Director Jackson Day, PCC Chair Jerry Shaver, Jeff Mechanic, FASB Senior Project Advisor and Chair of the Not-for-Profit Advisory Committee, Ashley Allen, FASB Practice Fellow, and two FASB Postgraduate Technical Assistants, Christina and Sam. There are a few housekeeping items to go through starting on the next slide. First, webcast slides are available on the FASB's website by clicking on Educational Webinars under the News and Meetings webpage. Next, to ask a question, type into the Q&A box and press send. We will do our best to respond to questions throughout this webcast. And for those questions that we're unable to get to during this webcast, we have a free technical inquiry service on our website where you can submit technical accounting questions. Playback of this webcast will be made available on our website for 6 months. However, CPE credit cannot be provided to those who watch the archive. Next slide. Up to 2.5 hours of CPE credit is available for viewing the live program. CPE credit is not available for group viewing. CPE credit is expected to be awarded within 14 days if the following requirements are met. 8 of the 10 polling questions must be answered. Please stay on the webcast for the required number of minutes, and we encourage you to complete the course evaluation at the end of the program. So what is on today's webcast agenda? Jack is going to kick us off by providing an overview of the FASB's agenda. Jerry will then talk about the Private Company Council, or the PCC, its agenda priority process, and Ashley will discuss some of the current PCC activities. And then moving into post-implementation review, Joyce will provide an overview of that process, and Joyce and Ashley will talk about some of the recent FASB and PCC post-implementation activities associated with leases and credit losses. Then Jeff will talk about recent discussions by the Not-for-Profit Advisory Committee, or the NAC. And then lastly, several of us will highlight certain FASB technical agenda projects and research projects. However, before we move into our first topic, we have polling question number 1. Did you participate in our May 2025 webcast FASB update for private companies and not-for-profit organizations? A, yes. B, no. C, you're not sure. Now, as we are waiting on responses, there is a PCC meeting coming up next month. The PCC will meet on December 11th and 12th, and that meeting will be broadcasted live on the FASB's website. On Thursday, December 11th, the meeting is scheduled to start at 3 p.m. and will conclude around 5 p.m. Eastern. And then on Friday, December 12th, the meeting will start at 9 a.m. Eastern and will conclude around noon. Expected discussion topics include 3 PCC research projects, leases, subjective acceleration clauses, and debt modifications and extinguishments. You're going to learn about 2 of those projects today. Other topics will include the FASB technical projects on equity method of accounting and digital assets. We'll talk about the FASB credit losses post-implementation review project and several other topics. So with that preview, we can go ahead and close out that polling question and send the results. Fantastic. We have a pretty big mix of folks. Some people are returning and others this webcast might be new to them. So appreciate you being here again. And with that, I'm going to turn it over to Jack.
Thank you, Jennifer. It's a pleasure to be here. It's always a great opportunity to engage with our stakeholders, and we want to thank you for all the many contributions you make. All right, let's go ahead and have a look at the FASB's current agenda. This gives a snapshot of what is on the agenda currently. We have 10 technical agenda projects. These are board projects. We have 2 EITF projects, a couple post-implementation reviews underway, and also 9 research projects. 7 of these technical agenda projects relate to recognition and measurement, and 3 of them relate to presentation and disclosure. We're going to give you an update of some of the details coming up. All right, next slide. As you can see from this slide, most of the projects on the FASB's technical agenda are close to being completed. Final ASUs are expected to be issued on most of the projects between now and first quarter 2026. It's important to note that the effective dates are being staggered currently through 2029 to give everybody an opportunity to smoothly implement the standards. Several of these projects originated from the 2021 agenda consultation. Others originated from the EITF and the PCC. With the completion of these projects, it's a good time for the FASB to undertake another agenda consultation, which I'm going to discuss in a few minutes. All right, let's move on, and I'll talk a little bit about the FASB's research agenda. So the first topic on the page is accounting for and the disclosure of intangibles is what it is. We've issued a ITC. This is a staff document that is sent out in advance of going to the board and recommending any project. Received a significant amount of feedback, which has already been discussed with the board, and will be working as a staff to research certain areas and come back and talk to the board to see if they want to add any projects. Next on the list is accounting for commodities, and that's about how to recognize and measure commodities. Consolidations of business entities. What we're looking into there is whether or not to have a single model for consolidation. Digital assets, there's a whole plethora of things that we're looking at there. We're looking at, actually, we started looking at whether or not stable coins should be classified differently. Went to the board a couple of weeks ago, actually, and they added a project on that topic, but also have been investigating matters around derecognition as well as the scope of crypto accounting. So a lot going on there. I'll save the rest of the details for later. Key performance indicators, the staff issued an ITC on that, received feedback, and has had an initial discussion with the board. That was in response to the 22 agenda consultation, where the staff and the board were told that there's lots of interest in key performance indicators. Hedge accounting, that is an ongoing response to ongoing feedback with regard to hedge accounting, that it's time for it to be updated and in order to make it more transparent to current business practices. Accounting for derivatives, looking into modifications and embedded derivatives, and whether or not there's an easier way to account for those that is more transparent. Statement of cash flows, that's a continuing topic that we receive feedback on with regard to cash flows. It's a continuing topic that we receive cash flows on. Blah, 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 blah. I apologize. It's a continuing topic that we receive information on. We have a project on the board has a project on its technical agenda to deal with financial institutions. This is a little bit more broad. And finally, agenda consultation, received the results back from the agenda consultation, discussed that on October the 8th. All right, let's move on. In the second half of 24, the staff conducted outreach with over 200 preparers, including investors, practitioners, preparers, and academics. In 2025, the FASB issued an agenda consultation invitation comment, as I mentioned earlier, to understand the next priority areas the board should discuss. The FASB received over 120 responses to the ITC. This includes feedback and comment letters, stakeholder outreach meetings, and advisory group meetings through the end of August. You can see from this pie chart that it came from a cross-section of different stakeholders, including investors, preparers, practitioners, trade group, and others. The stakeholders represent a variety of industries such as financial services, pharmaceuticals, oil and gas, energy, and crypto. This slide highlights select topics that were included in the agenda consultation ITC and the percentage of total respondents that identified each as a top and a low priority as recommended by stakeholders. There was a wide range of perspective received across the topics. While some of the topics were consistently identified as top or low priorities by stakeholders, others received more varied responses, with the views split between top and low priority. Also, even when topics were consistently identified as a top priority, the feedback was often diverse on how the board should address identified issues. For example, stakeholders identified risk management and hedge accounting and outdated disclosures as a top priority, but provided numerous recommendations on how the board should address those topics. The board will discuss more than 70 suggestions in a public board meeting during 2025 and 2026 as initial research is completed. All right, now we're ready for the next slide. This slide gives an overview of the agenda consultation feedback for which the PCC priority areas identified in June 2025 were considered. PCC members stated that equity method accounting, distinguishing liabilities from equity, consolidation for business entities, definition of a public business entity, and employee stock ownership plan repurchase obligation disclosures were a top priority. At its September 2025 meeting, the PCC also expressed an interest in the board addressing principal versus agent issues in the revenue recognition guidance. The definition of common control and multi-element software arrangements were identified by the PCC as a lower priority for standard setting. For topics like the first 5 listed here on the slide, stakeholders provided mixed feedback on the priority for standard setting by the board and the PCC. But they did provide several solutions that the board or PCC could consider, some of which would be targeted improvements and some of which would result in broader projects. While identified by the PCC as a priority, ESOP disclosures and multi-element software were considered lower priorities by stakeholders as a whole. All right, on to slide 15. Similar to the PCC, the NAC provided input on the agenda consultation in March on the 6 topics listed on the slide. It also includes feedback from the agenda consultation ITC. Many of the topics the NAC identified as a top priority received mixed feedback from stakeholders, including enhanced disclosures, the statement of cash flows, KPIs, and the definition of a PBE. The interaction of consolidation guidance and other transactions generally receive more support from stakeholders, but the majority of this feedback was related to asset acquisitions and business combinations. Stakeholders generally agreed that below market and interest-free loans from donors is a low priority. For categorization purposes, financial KPIs for business entities is included, but the specific topic the NAC brought up at its meeting was related to the operating measures for not-for-profits. All right, on to the next slide. As I mentioned earlier, on October 8th, the staff presented a summary of the feedback to the board. If you would like to read a summary of that feedback, it is included in a handout for the October 8th board meeting found on the FASB website. The board is now in the process of analyzing feedback against its agenda decision criteria as part of its overall agenda prioritization process And through a series of meetings, the board will decide which topics to add to the technical agenda. Once the board has completed analyzing feedback received, an agenda consultation report will be issued to summarize the feedback and how the board considered it. Before a project is added to the agenda, the FASB must evaluate the issue and determine, first of all, is there an identifiable and a sufficiently pervasive need to improve GAP? Are there technically feasible solutions? And are the expected benefits of those solutions likely to justify the expected cost of change? Does the board have an identifiable scope? Decisions about whether a project meets these criteria is a matter of the board's professional judgment that is informed by the research and analysis performed by the FASB staff. If the board believes that the criteria are met, a project will be added to the agenda. Time for a polling question. Jennifer, are you going to take this?
I am. Thank you, Jack. This has a lot of options here. So which of the following best describes the organization you work for? A, local CPA firm. B, regional or national CPA firm. C, private company. D, not-for-profit organization. E, a user of financial statements. So for example, a lender, private equity, surety, grantor. Or F, other. So as we wait for participants to respond, just wanted to mention this again. You can ask us questions during today's webcast. We will do our best to answer them as we make our way through the various topics. And if we run out of time, then you can submit your technical accounting question through the technical inquiry service located on our website. So I've got 3 quick trivia questions to go through as we give folks time to respond. The first one is, what year was the FASB established? The answer is 1973. So it's been around a few years. The second question, what year was the Private Company Council established? It's not quite the same age as the FASB. Rather, it was established in 2012. And then the last trivia question, what year was the Not-for-Profit Advisory Committee established? And it's 2009. So looks like we've got almost everybody that has responded to the polls, and we can go ahead and close that out and send the results. Fantastic. As I take a look at these results, we have a diverse mix of folks attending the webcast today. So thank you again for joining us. So with that, I'm going to turn it over to Jerry.
Thanks, Jennifer. Hopefully I'm appearing there somewhere.
Yep, we can see you, Jerry.
Okay, great, because I can only see you. So thanks for having me and welcome. So glad to be here with you today. I'm Jerry Shaver, and I have the privilege of speaking to you today as the chair of the Private Company Council. I'm in the midst of finishing up the end of the second year of my first term, and I think we've accomplished a lot. Why don't we go to slide 20? So, as Jennifer just said, formed in 2012, the private company was established to primarily advise the FASB about its ongoing activities. But in connection with that, we have 3 primary priorities. And I'm actually going to go from right to left on your slide rather than left to right, because I think one of the most important things that we do is getting an opportunity in outreach to speak to private company stakeholders like we are holding in this session today. We hold a variety of town hall and liaison meetings throughout the year. We meet with technical experts like the AICPA Technical Issues Committee. We meet with more widespread members of our constituency through the AICPA Engage Conference. To understand what users' needs are, we meet with the ProSite Financial Association, which is a group of financial leaders from medium and community banks around the country. And in addition, we're a couple of different very large surety industry association groups we meet with who are as sureties, big users of the financial statements of private companies. To make sure we're hearing from people that just aren't in the CPA space, we also meet with the management accountants, small business shared interest group. So we hear a perspective from small companies as well. Uh, just recently, we met with both the Auditing Standards Board, Audit Issues Task Force, and the Construction Financial Management Association. Each of those give us unique perspective about the things they're hearing and seeing, in their roles in the private company space. When we start looking at private company alternatives, we use the private company decision-making framework, which you can find on the FASB website, and it really outlines the sorts of things we're going to think about as we evaluate adding items to our agenda. They're not unlike what Jack just went through with the FASB relative to importance, relevancy, the ability to reach a conclusion. But in that regard, the PCC has the opportunity to create our own agenda. And so we identify issues, we work with the FASB staff to have them researched, we deliberate, we talk about what the impact will be, we meet with users and preparers to understand what our alternatives might be, and then we vote. And if we pass something, it moves on to the FASB for their evaluation and whether or not they will bring it to fruition. In connection with that, during 2025, we successfully identified a matter related to credit losses with respect to accounts receivable and contract assets. And as earlier this year, the FASB issued some guidance that allowed private companies and not-for-profits to have some more straightforward ways to react to that. But probably on an ongoing basis, and the thing that we probably enjoy the most is we get an opportunity to advise the FASB as they're in the deliberation phase. We're hearing about research projects, like Jack mentioned, as soon as the FASB is. And so we can start talking about what the impact could be to private companies. In this past year, for example, in government grants and software costs, we were involved and had some good suggestions and leases in the day, but we continue to look at current and emerging issues in financial reporting. As I'll talk about in the next page, we're a volunteer organization. We meet 4 times a year, 3 in person in Norwalk, Connecticut, and once remotely. But all of those are televised, and would love to have you participate, as our meetings come up. Jennifer just mentioned we have a meeting coming up in December, and we're always looking for people to tune into our YouTube channel, which I think has many. It's not been thrown off of Disney, or I guess the other way around. So you can catch it next time. Next slide. So our members are composed of practitioners, preparers, users, and academics. And while as the chair, technically I'm a practitioner, the chair's role is not set aside for a practitioner position. We're represented by members from small, medium, and larger firms. We're trying to get a perspective from everyone. As we look at preparers, we want people who are faced with the challenges that monthly or quarterly or annually financial statement CFOs and controllers are dealing with, and how implementable are what we're bringing up. And we have great representation in that portfolio. In the user group, we have bank representatives in David Hoagland and Robert Messer. And while it doesn't say it there, Robert was the former senior executive vice president at American National Bank of Texas. And so, with he and the 2 Davids, we really get a good perspective on what users are. And then we're fortunate to have an academic among us as well. Brad Hendricks, an associate professor of accounting at UNC at Chapel Hill, a very renowned creator of accountants in the US. And Brad brings to us real expertise in corporate financial disclosures, among other areas. Next slide. Sorry. I got distracted by the questions pouring in. So in 2025, we issued the first ever annual report for 2024. We talked about the historical accomplishments of the PCC. We talked about what we're looking to try and do in the future. And it was another way for us to try and engage with our stakeholders by documenting what we've done and how it's moved forward. Some highlights from the 2024 annual report. We started a structured process for how we might get things on our agenda. We've identified early on, we identified maybe up to 20 potential items we could look at. We had some initial research performed on the 20. We surveyed the PCC members and the FASB staff, and then we went out and narrowed that list down to some priorities that we would be focused on. In 24, we met with almost 1,000 different stakeholders, and so we were really looking to see what kind of feedback that they gave us, so we could impact what our agenda would be. Shortly in 2026, we'll be coming out with our next annual report, continuing this strategy, but communicating with stakeholders is such a critical element of what we want to do, and we really need to hear from you. And so, later in the presentation, there's ways to connect, but JJ Weiss at FASB.org is the best way, as Jennifer is the primary contact for us. Moving on to our priorities, next slide, 20, don't see the number, 23. Thanks. So, as I mentioned before, some of the priorities we set up last year, the credit losses receivables, we went forward, the presentation and disclosure for construction contractors. We'll talk about that more in a minute. We're still working on some topics around debt modifications and extinguishments. And along with the AICPA Technical Issues Committee, we've created working groups related to debt modifications. We have our first meeting later today, but we have an ongoing group that's looking into some lease accounting simplification concepts that we're trying to assess. In March of 25, as we move through this year, we continued to look at things we were doing and things we shouldn't be doing. We looked at whether we should add some disclosures on weighted average disclosures and short cycle manufacturing, but we moved ahead instead with subjective acceleration clauses and the effective interest method. We're going to talk about that more in a minute. The other two we really concluded as 25 went on that perhaps they weren't the best use of our time. We're continuing to be focused on how we can address lease simplification. We know it's a challenge, especially for the smallest organizations, and we're looking at what some alternatives might be there. We have not reached any conclusions that we can share yet, but we continue to monitor what might make sense for us to do. Next slide. So I want to back up for a second. As we think about the matters that you guys raise to us, and a lot of the things we think about, they come from you, and they may affect you and they may affect your industry. But what we're trying to evaluate is the issue pervasive across many private companies, neither and not focused on large or small private companies, but all. And are there alternatives that we can actually come up with? Some of the things that I think we will look at in 26 in that regard, could well be some of the things that the FASB decided not to move forward with as they did their agenda consultation and created their new process looking forward. There's a couple of items on interest for us, I think, that perhaps are more appropriate for private companies to consider, but we haven't gotten to that point yet. So stay up to date on all the things we're doing. Our meeting schedule's published, our materials are available. You can watch our meetings live or watch the videos of them afterwards. In addition, we create some small updates after the meetings are over. We're continually searching for new members. Presently, the membership, people are appointed for initial 3-year terms with eligibility, to serve an additional 3-year term. The chair can serve up to 8 years, but from that population, practitioners, users, preparers, and in particular users and preparers, to the extent you're in public accounting or know people that are CFOs or controllers that you think might be a good fit for us. And again, we're not looking for the most experts in accounting. The FASB staff provides us with that expertise. We really need people that can help us understand what implementation looks like and what the challenges might be in a private company. And are our disclosures so onerous that it's not feasible for a private company to get all the information together? That's the sort of need we have, and it has to be someone who's willing to have an opinion and speak up about it. And so searching for members is as important a part of my job as anything else that we have going on. And I think we're on to the next poll question. Yes.
We are. Thanks, Jerry. So the question asks, are you familiar with the PCC agenda priority process and projects that the PCC currently working on? A, yes. B, no. C, maybe. So we did have a question come in about the status of the PCC's research project on debt modifications and extinguishments. It's a very insightful question. Jerry briefly mentioned this research project, and I'm happy to expand a little bit. So during 2024, the PCC and the FASB staff, they conducted, I'd say, a fairly substantial amount of research and outreach. And while outreach participants supported some type of private company simplification to the guidance in subtopic 470-50, debt modifications and extinguishments, there were, I'd say, fairly mixed views on what the problem is and how it can be solved. So at the PCC's March 2025 meeting, basically, there was a pause put on the project, and instead, the PCC members requested that the FASB staff do some research on a couple of other debt-related issues, including interest method in determining the effective interest rate and subjective acceleration clauses, which Jerry mentioned that as well. And Ashley's going to talk about that project here in a few minutes. Research on the interest method has since been performed, and it will be helpful to the debt modifications and extinguishments research project. Jerry also mentioned that a working group was just formed, and therefore research will now resume on the debt modifications and extinguishments research project. So if this is an area that is of interest to you and you want to provide input on what are the challenges in applying the guidance and your suggestions on how to simplify it for private companies, please reach out to me. My email address was on the slide previous to this one. So with that, I'll give just a few more seconds for folks to respond. We want to make sure you get your CPE credit, so get your responses in. Yes, no, or maybe were the responses that you could choose from. Okay, with that, let's go ahead and close out the poll and send the results. Okay, got again here a mix of responses. So with that, I'm going to turn it over to Ashley.
Hey, thanks, Jennifer. As Jerry briefly mentioned, a PCC-led initiative resulted in the April 2025 release of a FASB staff educational paper on the presentation and disclosure of retainage for construction contractors. For some background, companies that operate in the construction industry often are subject to contracts that contain retainage provisions. These provisions generally provide a form of security to the customer by allowing the customer to withhold a portion of the consideration billed by the company until certain project milestones are met or until the project is completed. The revenue guidance in Topic 606 requires that when an entity enters into a contract with the customer, the remaining rights and performance obligations of that contract are accounted for and presented on a net basis as either a contract asset or a contract liability, depending on the relationship between the entity's performance and the customer's payment. This analysis is done on a contract-by-contract basis. So accordingly, an entity may present both contract assets and liabilities on its balance sheet, but not for the same contract. Topic 606 also specifies that a receivable is an entity's right to consideration that is unconditional. So the determination of whether retainage should be classified as a receivable or included within contract asset or liability balances depends on whether the entity's right to that payment is unconditional. The PCC heard from private company stakeholders that there was diversity in practice in the presentation and disclosure of retainage. And users of private company financial statements, including sureties, provided feedback that information about retainage is important to their analysis, but indicated that the presentation and disclosure requirements under Topic 606 do not always provide decision-useful information because the netting of contract assets and liabilities can obscure information about retainage. As a result of this feedback, FASB staff issued an educational paper that both explains the presentation and disclosure requirements in GAAP about retainage and provides example voluntary disclosures of retainage that would provide users with more detailed information about these balances. Examples of voluntary disclosures that would be permissible under GAAP to provide users with more information include parenthetical disclosure of the amount of retainage included in contract asset and liabilities on the face of the balance sheet, the use of additional line items and subtotals on the balance sheet, the use of alternate descriptions for contract assets and liabilities on the balance sheet, and additional disclosures within the footnotes. The educational paper does not change or modify current GAAP. Moving next to the PCC's research project on subjective acceleration clauses. So like Jerry mentioned, since March, the PCC has been prioritizing research on the guidance on subjective acceleration clauses and determining the classification of debt as a current or non-current liability in a classified balance sheet. So I'll start with a brief overview of why this area is a current research priority. First, feedback has indicated that subjective acceleration clauses are pervasive in private company debt agreements. Second, some private company stakeholders have indicated that determining debt classification when a subjective acceleration clause exists can be complex, that diversity exists in applying the guidance, and that lenders often do not actually enforce these clauses. Additionally, private company financial statement users that we have performed outreach with support potential changes to this guidance. In addition to researching the guidance on subjective acceleration clauses, the PCC is considering debt disclosures as part of this research project. At its September 2025 meeting, the PCC provided preliminary observations on potential private company accounting differences and requested that the staff perform additional research and outreach. I'll talk more about those preliminary observations on the next slide. So a subjective acceleration clause, which is often called a material adverse change clause within debt agreements, is a provision in a debt agreement in which a creditor can accelerate the scheduled maturities of the obligation under conditions that are not objectively determinable. Under current GAAP, when a long-term debt arrangement includes a subjective acceleration clause, entities must assess the likelihood of the lender accelerating the due date, which is referred to as the probability assessment. The outcome of that probability assessment will determine whether the debt is classified as a current or non-current liability, and also whether disclosure is needed. The PCC is researching potential changes to this guidance for private companies. One of these potential changes is to remove that probability assessment, and instead, a subjective acceleration clause would affect the classification of debt only when it is triggered. Once a subjective acceleration clause is triggered, the debt would be classified as a current liability. There was robust discussion at the September PCC meeting surrounding what would constitute a trigger. Additional research is being conducted in this area, but the PCC has preliminarily discussed describing triggered as when a lender demands repayment. There are several other areas of the guidance that intersect with the guidance on subjective acceleration clauses, including the intent and ability to refinance guidance and the classification of revolving credit agreements guidance, which I'll cover on the next slide. So the intent and ability to refinance guidance precludes non-current classification of short-term debt that is intended to be refinanced on a long-term basis after the balance sheet date, but before the financial statements are available to be issued, in scenarios in which the financing agreement includes a subjective acceleration clause. The PCC is researching amending this guidance so that it is also trigger-based. That is, if a trigger of the subjective acceleration clause does not exist, the short-term debt could be classified as a non-current liability, assuming the other conditions in the guidance are also met. If a trigger does exist, the short-term debt would remain a current liability. Moving on to revolving credit agreements, under the current guidance, borrowings under certain revolving credit agreements are considered long-term debt because the borrowings are due at the end of a specific period, such as 3 years, rather than when the notes roll over. If these agreements also include a subjective acceleration clause, the effect of that clause on classification is based on the probability assessment guidance. Additionally, some revolving credit agreements also include a requirement to maintain a lockbox, whereby cash collections from customers are automatically deposited into the lockbox and applied to reduce the outstanding debt. Borrowings that contain both a lockbox requirement and a subjective acceleration clause are considered current unless certain refinancing conditions are met based on an agreement other than the revolving credit agreement. Additionally, some agreements include springing lockboxes, whereby cash remittances do not automatically reduce the debt outstanding until and unless a lender exercises a subjective acceleration clause. Borrowings outstanding under such agreements are considered long-term since the remittances do not automatically reduce the debt outstanding, and the effect of the clause on classification depends on the probability assessment. The PCC preliminarily supported amending the revolving credit agreement guidance so that it is also trigger-based, consistent with the other amendments being considered. I'll now turn it over to Joyce to discuss the FASB PIR process.
Thanks, Ashley. It's a pleasure to participate today. I'll now address the post-implementation review process, which is often referred to as PIR, and provide context about the nature of associated PIR activities. Next slide, please. As background, the FASB's PIR process is an evaluation of whether a standard is achieving its objective by providing financial statement users with relevant information in ways that justify the cost of providing it. It's an important quality control mechanism that's built into FASB's standard setting process. There are 3 stages in the PIR process. Stage 1 is the pre-issuance activity stage, which occurs right after the standard is issued and before it becomes effective. During this period, FASB monitors practice and provides clarity through implementation guidance or educational materials if needed. Stage 2 is the post-effective date evaluation stage, which involves conducting research and outreach with stakeholders to understand the costs incurred by entities in applying the standards and by investors in analyzing and interpreting the standard. We reach out to entities of varied sizes representing different industries, and we also aim to understand the benefits derived by investors and other users and entities from the standard. FASB monitors the ongoing application of the standard. In addition, during this stage, academic research may ensue to help inform us about the effectiveness of the standard. Stage 3 is the summary of research and reporting stage, whereby FASB summarizes its findings and reports to the Oversight Committee of the Financial Accounting Foundation Board of Trustees. They provide oversight throughout all 3 stages of the PIR. This stage also includes regular touch points with the board and the issuance of a final report, which represents a culmination of previous periodic updates. There are currently 2 active PIR projects, Topic 842 on leases and Topic 326 on financial instruments credit losses. And that transitions us nicely into our next topic, which is the Leases PIR project and the PCC's Leases Research project. For background, the FASB's Leases Standard was issued in February 2016, and it was a result of joint efforts between the FASB and the IASB in order to increase transparency and comparability among organizations by recognizing lease assets and lease liabilities on the balance sheet and disclosing essential information about leasing arrangements. So Topic 842 recognizes lease assets and liabilities on the balance sheets, and leases are required to be classified as operating or finance leases, similar to legacy GAAP. The lessor requirements in Topic 842 were intended to be generally consistent with legacy GAAP, but more closely aligned with the revenue recognition guidance in Topic 606 on revenue from contracts with customers and Topic 610, which is other income guidance. The Leases Standard became effective in 2019 for public entities, not-for-profit entities that issue or are a conduit bond obligor for securities that are traded, listed, or quoted on an exchange or an over-the-counter market, and for employee benefit plans that file or furnish financial statements with or to the SEC. And after the board provided 2 effective date deferrals, the LISA standard was effective for all other entities in 2022. The PIR of the LISA standard began immediately after ASU 2016-02 was issued. Just a few words about establishing a transition resource group. Now, the FASB intentionally decided not to form a transition resource group for the LISA standard, primarily because many of the key concepts in the standard were similar to those used in Legacy GAAP. However, the board and staff assisted stakeholders during the implementation of the LISA standard by proactively seeking feedback on implementation issues arising from those efforts. Stakeholder feedback later indicated that had FASB formed a transition resource group, it might have delayed the implementation efforts by entities. The stakeholder feedback received during the PIR process also indicated that implementation support provided by the board and staff was effective and it was efficient. Stakeholders noted that many of the issues raised during the implementation process related to the transition to the LISA standard and the changes to an entity's systems and processes, rather than the technical application of specific requirements. In addition, stakeholder feedback throughout the PIR process led to the board issuing 8 ASUs, which provided clarification or simplification in various areas, and 2 ASUs that defer the effective date for non-public entities, as I previously mentioned. Furthermore, the board provided ongoing implementation support through the FASB's Technical Inquiry Service, as well as the issuance of a FASB staff Q&A paper, interactions with stakeholders through advisory group meetings, and outreach discussions in individual and group stakeholder sessions during the transitional periods. I'd like to highlight several more aspects of the PIR outreach. During the PIR process, the staff proactively engaged with stakeholders to discuss lessee and lessor accounting in both formal and informal settings to solicit their feedback. A significant number of meetings were held with FASB advisory groups, regulators, public accounting firms, the AICPA's Technical Issues Committee, industry groups, and individual public and private preparers during the PIR. We held a public roundtable in September 2020 with investor, preparer, and practitioner stakeholders to discuss some of the fundamental areas of the lessee requirements. And we held another public roundtable in September 2025 to discuss the benefits and costs of the leasing standard. And we also addressed initial and ongoing application challenges and feedback on the standard setting process. In addition, the staff surveyed public entity and non-public entity financial statement preparers about their experiences with implementing and subsequently applying the LISA standard. As a result, we collected additional data, and that helped us to assess the benefits and costs of the standard. The staff actively monitored agenda requests and technical inquiries for pervasive implementation or ongoing application issues for lessees. In addition, as part of the LISA's PIR process, the staff reviewed 33 academic studies that were undertaken between 2021 and 2025 to assess whether the standard achieved its primary objective and to evaluate associated consequences. Now, those studies covered a range of topics related to the effect of the LISA standard on public entity leases, such as changes made to their leasing activities, costs incurred to implement the standard, and operability benefits. Additionally, the research studies considered the effect of the LISA standard on lessees' financial statements for public entities, the decision usefulness of financial information provided to investors, and the effect on certain industries, as well as the effect on the capital markets. So allow me to share some of the observations that have been made so far. In general, the objective of providing investors with a more faithful representation of the lease rights and obligations is accomplished. The benefits are generally consistent with what the board expected. However, the nature and magnitude of implementation and ongoing compliance costs were higher than the board's expectations when the standard was issued. We continue to hear feedback about the costs of applying the leases standard, most notably from private company stakeholders, and we will discuss the PCC's research project on leases in a few minutes. We also got stakeholders' feedback on improvements to the standard setting process. A few of those I'd like to mention. They include setting effective dates, that is, to better anticipate the length of time it may take for a standard to be applied. Also, as it relates to the standard setting process, determining transition guidance with consideration given to the complexity of the provisions and the effects of multiple transition options. In addition, better consideration of systems and process assumptions and expected implementation costs, and better defining the objective of a project with early stakeholder input. Looking forward, the staff is working to finalize the leases PIR process soon, which will include a report that will be published and available on our website. Jennifer?
I think Ashley's going to jump in here.
Okay.
Thank you, Joyce and Jennifer. So as Jerry and Joyce mentioned, the PCC has an ongoing research project on leases as they continue to receive feedback that certain areas of the guidance can be costly and complex to apply. So while the standard already provides some relief for private companies through various practical expedients, the PCC decided that additional simplifications for private companies should be explored. The PCC formed a leases working group in August 2024, which consists of members of the PCC and the AICPA Technical Issues Committee, or TIC. Since then, the working group has held several meetings and conducted comprehensive outreach with private company stakeholders. The most recent working group meeting was held in late July, with another meeting scheduled to happen before the December PCC meeting. At its September meeting, the PCC discussed results of the research and outreach conducted by the working group to date. The PCC also discussed and will continue to discuss further at the December meeting potential simplifications to the standard. The specific areas currently being researched by the PCC and its working group include an optional single lease classification accounting model, a low value lease exception, embedded leases, and lease modifications. I will note that these research projects are in the very, very early stages, but will briefly expand on the single lease classification model and low value lease exception considerations. So as you are aware, under the leases guidance, there's a dual classification model for lessees, whereby leases are classified and accounted for as either an operating or finance lease. Conversely, under International Financial Reporting Standards, or IFRS, all leases are classified and accounted for in a manner similar to finance leases. The PCC is exploring an optional single lease accounting model for private company lessees under which all leases would be accounted for as finance leases. Some feedback has suggested that a single classification model could reduce the cost and complexity in applying the leases guidance. However, others have expressed concerns that such an option would significantly impact ratios such as EBITDA and may not significantly decrease cost and complexity, given that systems and processes are already in place. The PCC is also exploring a low-value lease exemption. So under GAAP, there is no recognition and measurement exemption for leases of low-value assets. But under IFRS, a lessee is permitted an exemption for leases of underlying assets that are determined to be low value. The basis for conclusions in IFRS 16 explains that these are assets of approximately $5,000 or less. While materiality exists in US GAAP, some stakeholders have indicated that the guidance may not provide sufficient relief and that a low-value lease exemption could reduce some of the costs in applying the lease's guidance. The PCC also has had some discussions around certain lease disclosures, such as the weighted average discount rate and remaining lease term, and enhanced related party disclosures. At a future meeting, the PCC will decide whether to add a leases project to its technical agenda.
Thanks, Ashley. So we now have polling question number 4, and I think Jack is going to lead us through this polling question, as well as he's got a question that came in to answer.
Yeah, here we go. Are any of the following areas challenging for your organization or those you audit when applying topic 842 leases? And if there's more than one, you can choose the most challenging area. A, embedded leases, B, lease modifications, C, disclosures, D, no further challenges, and E, some other area. All right. Well, everybody has the opportunity to answer that polling question. I'm going to answer a question that I received. And it goes something like this. Jack, you spent a long time on the research agenda. Can you clarify how projects get added to the research agenda? Well, the FASB chair adds projects to the research agenda, normally based on issues identified through stakeholder feedback, such as agenda consultations that we discussed, technical inquiries, advisory group input, emerging practice challenges, and other avenues. The FASB staff performs research to understand the issue, assess its pervasiveness, and evaluate the potential solutions. The staff then presents to the board its findings, which considers factors like investor relevance, cost benefit, and whether the issue aligns with the FASB's mission to improve financial reporting. If the board determines that the topic warrants further study, the staff will perform more research, and then the board decides whether or not to add it to the technical agenda. So the board adds things to the technical agenda, and the chair adds things to the research agenda. How are we doing with our polling results?
We have quite a few people responded, 93%. So
All
just
right.
couple more seconds here.
So lease modifications is the big winner, and that's one that we've actually been talking about at the PCC, as well as embedded leases. That's another one the PCC has been talking about. So
Yeah, and one other thing I noticed in some other area, 12% of you responded to that choice. Be curious, if you're willing to put it in the Q&A, let us know what that other challenging area is that is not in choices A through D. So I think with that, we can turn it back to Joyce to talk about credit losses.
Thanks, Jennifer. Before I begin, however, I see a question that came in that I'd like to address. How long does the PIR process typically take? Well, the timing of the PIR process varies depending on factors such as the complexity of the standard, the nature and the extent of stakeholder feedback, and the timeline for implementation of the standard itself. It may also depend on whether additional guidance is issued or whether additional projects are added to the technical agenda to change the standard. So the time frame is unique and standard specific. Okay, so let's turn to credit losses or CECL. We'll look at the CECL PIR process and certain projects that have emerged as a result of the PIR activities. Next slide. So the board is performing a PIR on CECL to evaluate its effectiveness since CECL is a major comprehensive project. Following the issuance of CECL, the board continuously solicited stakeholder feedback and analyzed publicly available information to understand how the board's expectations when issuing the CECL guidance compare to the costs and benefits materializing in practice. If the board finds unintended consequences during the execution of a PIR, it could decide to respond in real time. In the case of the CECL PIR, the FASB staff issued 2 Q&A documents after receiving a high volume of questions on the application of CECL. Additionally, the board added 3 projects to its technical agenda to address PIR feedback on troubled debt restructurings, disclosures, and purchased financial assets. An additional project was initiated by the PCC to address feedback on the application of CECL to short-term receivables. We issued Update 2022-02 in March of 2022 to eliminate the guidance for estimating expected credit losses on TDRs and to enhance the disclosures required for certain modifications. Update 2022-02 also added gross charge-offs to the information that must be reported in the vintage table disclosure that is required by CECL. The Purchased Financial Assets project was finalized last week with the issuance of ASU 2025-08. I'll discuss that project next before turning it over to Ashley, who will cover the PCC project and Update 2025-05. The board initiated the Purchased Financial Assets project to address an issue with comparability and the complexity associated with the purchase accounting for financial assets under CECL. The issue stems from a different accounting model applicable to assets that have experienced a more than insignificant deterioration of credit quality since origination, referred to as Purchased Credit Deteriorated or PCD assets. The board issued CECL expecting that most financial assets would be accounted for as PCD. However, the percentage of financial assets accounted for as PCD has been reported in a wide range for business combinations and asset acquisitions that are accounted for under CECL. The disparity creates confusion for investors, notably when they are analyzing the financial information reported for acquisitions that otherwise appear comparable. Update 2025-08 addresses this by introducing seasoning guidance to expand the population of assets that qualify to be accounted for like PCD assets at acquisition without being reported as credit deteriorated assets. The seasoning guidance has a qualitative and quantitative assessment which is performed by the acquirer at acquisition to identify purchased seasoned loans. ASU 2025-08 is effective for annual reporting periods beginning after December 15, 2026, including interim periods within those annual reporting periods. Early adoption is permitted in an interim or annual reporting period in which financial statements have not yet been issued or made available for issuance. If an entity adopts this update in an interim period, the amendment should be applied as of the beginning of that interim period or the beginning of the annual reporting period that includes that interim reporting period. Next, I'll pass it off to Ashley to address the Topic 606 Credit Losses project.
Thanks, Joyce. So as mentioned previously, the credit losses for AR and contract assets project was initiated by the PCC. For some background, stakeholders indicated that identifying, analyzing, and documenting macroeconomic data, such as unemployment rates and property values, as part of developing reasonable and supportable forecasts when estimating expected credit losses on certain short-term assets can be costly and complex, and generally does not have a material effect on the estimate of expected credit losses for these assets. In addition, stakeholders observed that estimating expected credit losses for assets that were collected before the date that the financial statements were available to be issued can require significant effort and documentation and can result in recording estimates for expected credit losses for amounts that have been subsequently collected. To address this feedback, the amendments in this update introduce a practical expedient for all entities and an accounting policy election for entities other than public business entities related to applying the credit losses guidance to current accounts receivable and current contract assets arising from transactions accounted for under Topic 606. The practical expedient allows all entities, when developing reasonable and supportable forecasts as part of estimating expected credit losses, to elect to assume that current conditions as of the balance sheet date do not change for the remaining life of the asset. The accounting policy election permits entities other than public business entities that elect the practical expedient to make an accounting policy election to consider collection activity after the balance sheet date when estimating expected credit losses. Next slide, please. So as I mentioned, the practical expedient is applicable to all entities who elect it. The accounting policy election applies only to entities other than public business entities. And the amendments apply to current accounts receivable and current contract assets arising from transactions accounted for under Topic 606. Moving next to disclosure, transition, and effective date. So entities will be required to disclose that the practical expedient and/or the accounting policy election has been used, and for entities that elect the policy to consider subsequent collection activity, disclose the date through which subsequent collections were considered. Transition will be prospective. An entity other than a public business entity will not need to perform a preferability assessment. And the amendments will be effective for annual reporting periods beginning after December 15th, 2025, and interim reporting periods within those annual reporting periods. And early adoption is permitted for all entities. Next, we're going to demonstrate a quick example of how to apply the guidance. So this example is modeled off of case 3 of the ASU. To set up the example, assume an entity other than a public business entity has the following outstanding balances and historical loss rates for its portfolio of receivables as of the balance sheet date. Next slide. Now let's assume that the entity elects the practical expedient and accounting policy election and selects March 1st as the post-balance sheet date evaluation date. The entity has not identified other information that is expected to affect the collectability of its receivables other than the subsequent collection activity as shown on this slide. Under the practical expedient and the accounting policy election, the entity would develop its estimate of credit losses by evaluating the collection activity between 12/31 and March 1, which is the date that the entity has selected to consider subsequent activity. This can be seen in the third column. So the entity would then use this collection data to reduce the balance of outstanding receivables as shown in the fourth column. The entity would then age the remaining receivables and reclassify their delinquency status as of the date the entity selected to evaluate the collection activity, which is demonstrated in the fifth column. The entity would then apply the appropriate credit loss rate based on the new delinquency status to estimate credit losses. And those outcomes are seen in the sixth and seventh columns. And with that, I think we're ready for our next polling question.
We are. If you can launch polling question number 5. So this is the 5th of 10 polling questions. It asks, do you anticipate or have you experienced that the amendments in ASU 2025-05, so this is the ASU that Ashley just talked about, will it reduce the cost and complexity in applying the credit losses guidance? A, yes. B, no. C, not sure or not applicable. And as we're waiting for participants to respond, are there any questions that have come into the queue that speakers would like to address at this time? And if not, I'm happy to take one. So there's somebody that was asking about the FASB's technical inquiry process, like what does that entail? So it allows stakeholders to submit accounting questions electronically through a FASB technical inquiry form when clarification is needed on existing guidance in the codification. Before submitting your question, we ask that you research the relevant codification and clearly define this specific issue and consult internally with other senior accounting staff and if applicable, discuss it with your auditors. And then once submitted, the FASB staff reviews and responds, typically within about 2 weeks, although timing depends on the question's complexity and staff availability. Usually you'll get an email saying, "Thank you for your question. We'd like to set up a video meeting to talk to you." Responses, they are generally informal staff views. They are not official FASB positions. So with that, we've got about 93% of you have responded to this polling question. I want to give you a few more seconds. Got to make sure you get your CPE credit. I know some of the states, the cutoff is coming up here at the end of next month. Okay, with that, let's go ahead and close out the polling questions and the results. Okay, so again, here it's a mix. About 50% of you are not sure, not applicable, and 36% said yes. Okay, with that, I'm going to move on and turn it over to Jeff.
All right, thanks, Jen, and it's great to be with everyone here today. Let's move on to the next slide. So at the October NAC meeting, the committee discussed various projects. The centerpiece of the meeting was agenda consultation, which involved closed breakout group discussions, followed by a public report out and full group discussion. NAC members suggested the items on the slide for potential projects for the board to consider. However, it's important to note that NAC members didn't indicate that any of these as being urgent. So first, some members, especially users, suggested enhancing disclosures such as those on risks and uncertainties, for example, with not-for-profits that are significantly funded by government grants. Secondly, on the composition of net assets, especially with regard to temporary versus permanent nature of various restrictions. Third, for disaggregation of realized versus unrealized gains and losses. Fourth, the liquidity disclosures, especially the qualitative ones, which we've heard have become sometimes, at least, a bit boilerplate-ish in practice. And then finally, on disclosures on expected contract revenues. Now, in contrast, other members, especially preparers, suggested streamlining disclosures where possible, though there weren't specific suggestions made at the meeting. Third, amending the definition of cash equivalents to better distinguish those from certain short-term investments. Fourth, improving the not-for-profit consolidations and mergers and acquisitions guidance, including their navigability, to help ensure reporting outcomes that best reflect the economics of certain arrangements. Fifth, standardizing an operating measure, but by specifying the line items that should be included in operating versus non-operating activities, rather than what we tried to do a decade ago, which was develop a broad principle. Sixth, the sixth area that they suggested was reconsidering the measurement guidance for asset retirement obligations, AROs, given the complexities with estimating fair value there. Seventh area was excluding not-for-profits with conduit or other public debt from various public entity definitions in GAAP, and instead grouping those entities with other not-for-profits for accounting and transition matters. And then the final area was eliminating the diversity and valuation of certain non-financial assets held for investment, for example, oil, gas, and mineral rights, depending on how those assets are held, for example, directly or through a beneficial interest in a trust. Let's move on to the next slide. Additionally, the NAC members discussed emerging financial reporting issues in the not-for-profit sector and select FASB projects and other research. In the emerging issues topic, which is a standing agenda item at all NAC meetings, much of the discussion was about risks and uncertainties and the level of disclosures in not-for-profit financial statements about those. One of the areas cited as giving rise to risks and uncertainties was the changing government funding landscape. And in that regard, one of our NAC members also suggested that some refinements could be made to the contribution model to better address measurement uncertainty. As you saw in the previous slide, enhancing disclosure of risks and uncertainties was also an area cited by NAC members for potential board attention during the agenda consultation discussion that followed. One other noteworthy discussion at the October 7th meeting was on the PCC's research project on subjective acceleration clauses. There, NAC members, including both of our lender users, indicated that many of the issues being discussed by the PCC with regard to private companies are germane to nonprofits as well, with the possible exception of some of the lockbox issues. Now, finally, before I turn things over to Jen for our next polling question, I also wanted to note that a recap of the October 7th meeting is now also available on the FASB's website. So back to you, Jen.
Thank you. Okay, polling question number 6. Have any of the topics discussed at the October 2025 NAC meeting affected your organization? So these are the topics that Jeff just talked about. A, yes, most of them. B, yes, some of them. C, no, or D, not sure or not applicable. As participants are completing those that polling question, would speakers like to address any of the questions that have been submitted?
Yeah, Jen, I have a couple that have been submitted that I'd like to address. The first one asks if we've considered reaching out on nonprofit matters to the Tax Exempt and Government Entities Council, which is a group of practitioners that deals with the IRS's Exempt Organizations Division and sends requests directly to the IRS. Well, as you may know, the IRS Form 990 is a bit different document and has some different aims than a set of GAAP financial statements. But if that group is also monitoring GAAP and potential changes to GAAP, we'd very much like to know a little bit more about the group. So feel free to send information to me about that group. The other question I received is, give us a little bit idea about who's on the NAC and how long is their term. Let me answer the first part, the last part first. NAC members serve for a 4-year term, and the group consists of about 15 to 20 members. About a third of them are senior financial officers at various types of not-for-profit organizations, what we call preparers. About a third are practitioners, auditors who serve the nonprofit sector. And the last third are users of financial statements of not-for-profits, which are lenders, grantors, folks from rating agencies, and we even have an academic who does teaching and research in the nonprofit area. So again, back to you, Jen.
Thanks. And thanks for submitting those questions. Okay, with that, I think we can go ahead and close out that polling question. Except I'm not seeing it closed out, but I will assume it has been. And so there we go. Okay, sorry about that. Okay, so it looks like some folks, about 40%, said that the topics that Jeff discussed affects their organization. So I'm going to turn it over to Ashley.
Thank you, Jennifer. So now we will be moving on to select recently issued and forthcoming ASUs. Next slide. So the first recently issued ASU that I'm going to discuss is ASU 2025-06, Targeted Improvements to the Accounting for Internal Use Software. So this project was added to the board's technical agenda in 2022 in response to feedback received on the 2021 agenda consultation, which indicated that the accounting for internal use software should be a top priority for the board. That feedback indicated that the existing internal use software guidance is outdated. As software development has evolved, many entities have shifted from using a prescriptive and sequential development method, such as a waterfall method, to using an incremental and iterative development method, such as an agile method. Stakeholders indicated that the existing internal use software guidance does not address software developed using methods such as agile, which led to diversity in practice in determining when to begin capitalizing costs. As a result, the board decided to make targeted improvements to modernize the accounting for internal use software costs under subtopic 35040. Costs in the scope of 35040 include costs incurred to develop or purchase software that is solely for an entity's internal use, such as ERP systems, costs incurred by a customer to implement a cloud computing arrangement, and costs incurred to develop a hosting arrangement platform. The board decided not to make targeted improvements for costs in the scope of subtopic 98520, which include costs incurred to develop software to be sold or licensed to customers, and costs incurred to develop software used in a hosting arrangement in which the customer can take possession. A proposed ASU was issued in October 2024, and comment letters were due at the end of January. We received 40 comment letters on the proposed update. Overall, the majority of respondents supported the proposed amendments, including the board's decision to pursue targeted improvements to the internal use software guidance. Respondents said that the proposed amendments would generally be operable and or auditable and would clarify and improve the application of the guidance. The board discussed comment letter feedback and completed redeliberations in May, and a final ASU was issued in September. Moving next to transition and effective date. The board decided that entities would be permitted to apply the guidance using a prospective approach, a modified transition approach, or a retrospective approach. Under the prospective approach, an entity would apply the amendments to software costs incurred beginning after the effective date for new projects and in-process projects. Under the modified transition approach, an entity would apply the amendments using a prospective approach for new projects and in-process projects, except for in-process projects that, as of the adoption date, an entity determines do not meet the capitalization requirements under the new guidance, but did meet the requirements under the old guidance. For those in-process projects, an entity would de-recognize any previously capitalized costs through a cumulative effect adjustment to the opening balance of retained earnings or other appropriate component of equity or net assets. Under the retrospective approach, an entity would recast comparative periods and recognize a cumulative effect adjustment to the opening balance of retained earnings or other appropriate component of equity or net assets as of the beginning of the first period presented. The amendments will be effective for all entities for annual reporting periods, including interim reporting periods within those annual reporting periods beginning after December 15th, 2027 or calendar year 2028. And early adoption is permitted for all entities. Okay, so the next slide highlights the key changes under the amendments. The previous guidance was based on a model that referred to software development project stages, which are common in prescriptive and sequential software development methods. Under that guidance, the starting point for capitalization of internal use software began when the preliminary project phase was completed and both management had authorized and committed to funding the software project, and it was probable that the software would be used to perform the function intended, which is referred to as the probable to complete threshold. The amendments remove all references to project stages, which will make the guidance neutral to different development methods, including more modern development methods such as Agile. Under the amendments, capitalization will still begin when management has authorized and committed to funding the project and when the probable to complete threshold has been met. However, there is no assessment of whether the preliminary project stage has been completed. Under the improvements and evaluating the probable to complete threshold, an entity is required to consider whether there is significant uncertainty associated with the development activities of the software. In assessing whether significant development uncertainty exists, an entity evaluates whether the software being developed has technological innovations or novel, unique, or unproven functions and features, and the uncertainty related to those technological innovations, functions, or features, if identified, has not been resolved through coding and testing, and whether the entity has determined what it needs the software to do, that is, whether the entity has identified or continues to substantially revise the software's significant performance requirements. If an entity determines that significant development uncertainty exists, the probable to complete threshold is not considered to be met and capitalization of costs will not begin. While the board decided that entities are required to evaluate significant development uncertainty for all software projects, they believe that this evaluation will be straightforward for some projects, such as the development of an ERP system. The guidance also removes the specific website development guidance in subtopic 350.50 and incorporates certain aspects of that guidance into the internal use software guidance. This was because feedback indicated that this guidance was infrequently applied or that the cost to develop a website separate from the underlying software are often immaterial. And lastly, the board decided not to require any incremental changes to presentation and disclosure. Rather, the amendments clarify that the disclosures in topic 360 for PP&E are required for all capitalized internal use software costs, regardless of how they are presented in the financial statements. Additionally, the amendments clarify that certain intangible asset disclosures in subtopic 350.30 are not required for capitalized internal use software costs. And with that, I think we are on to polling question 7.
And I'm going to take that because I can read a polling question too. So question 7, will the amendments in accounting standards update 2506 intangibles, goodwill, and other internal use software, subtopic 35040, targeted improvements to the accounting for internal use software impact your organization or those you audit? You have 4 choices: yes, no, maybe, and not applicable. So take it away. And while you're doing that, there was a question that came up earlier about the PCC and evaluating gap overload, in particular as it relates to disclosure. And so one of the topics that keeps coming up as we evaluate what our future agenda will be includes what to do about disclosures. And so some of the outreach that we have been doing, in particular as it relates to leases, as it relates to the debt modifications, we're also talking to preparers and users about what they use and what's important and how expensive it is to go through this process for them, whatever that process might be. I won't commit that we will add something to our agenda, but I think one of the things we're trying to be incredibly focused on as new standards come up in particular, do the disclosures make sense for private companies? Do they have systems and processes that can gather that information regularly? Or are there other things that private companies can do to provide information that are less costly? And so, yes, we are considering it. Thank you for your question. And again, want to thank all of you for being here and your contributions, in the chat and the questions today to help us shape what the agenda will be going forward. So I don't know if the polling question results are up yet.
Yep, we can go and close that out and push the
There they are.
results.
And so we have a lot of responses again out of the roughly 800 people here. I can't tally the math immediately, but yes, no, and maybe are big. So always like real definitive answers. So thanks for playing along.
Great, thank you. Christina is now going to talk about accounting for government grants.
Thank you, Jennifer. Hi, everyone. The next project that we are going to discuss is accounting for government grants. Current GAAP does not provide guidance for how business entities should recognize, measure, or present government grants. In the absence of specific guidance, many business entities analogize to the guidance in the IFRS standard on government grants, also known as IAS 20, or less commonly, the guidance in Topic 450 on contingencies, or subtopic 958-605 on the accounting for contributions, which excludes transfers from a government to a business entity. The absence of specific guidance has led to diversity in practice. In 2021, the board issued disclosure guidance related to government grants. But even with the disclosure standard, the lack of specific guidance was highlighted as an issue where improvements were needed. The objective of this project is to establish authoritative guidance on the accounting for government grants received by business entities. The project was initially added to the technical agenda in November 2023. The board issued a proposed ASU in November 2024 that leverages the guidance in IAS 20 on government grants, with targeted improvements and conforming changes. The board completed redeliberations in June 2025, and a final standard will be issued in the fourth quarter of 2025. These amendments will only pertain to business entities. Not-for-profit entities already have guidance to account for government grants in subtopic 958-605. Next slide, please. This slide focuses on the scope. A government grant is defined as a transfer of a monetary or tangible non-monetary asset, other than in an exchange transaction, including an exchange transaction that may be a significant discount to fair value, from a government to an entity, except for a nonprofit entity in an employee benefit plan. The scope excludes transactions within the scope of Topic 740 on income taxes, the benefit of below market interest rate loans, and government guarantees. Examples of transactions that are within the scope include a transfer of cash to fund future expenditures or reimburse expenditures already incurred. For example, capital expenditures, wages, training, and other employee-related costs, research and development expenses, or other operating expenses. A transfer of a tangible non-monetary asset, such as a long-lived asset, for example, a building, a land, or equipment, and the proceeds of a forgivable loan when recognition criteria are met, for example, PPP loan. And finally, a refundable tax credit that is not within the scope of Topic 740. Examples of transactions that are not within the scope include the transfer of an intangible asset or provision of a service, government participation in the ownership of an entity, a reduction of an entity's liabilities, for example, sales, properties, payroll, or other tax abatement. Next slide, please. There are two types of grants. One, a grant related to an asset, and a grant related to income. A grant related to an asset is a government grant that is conditioned on the purchase, construction, or acquisition of an asset. For example, a long-lived asset or inventory. For a grant related to an asset, a business entity should not recognize a government grant until it is probable that 1, the business entity will comply with the conditions attached to the grant, and 2, the grant will be received. In addition, a business entity should recognize a government grant on the balance sheet as it incurs the related costs for which the grant is intended to compensate. When accounting for a grant related to an asset, an entity can elect one of two approaches: the cost accumulation approach or the deferred income approach. The cost accumulation approach reflects a grant as an adjustment to the cost basis in determining the carrying amount of the asset. The carrying amount of the asset that includes the grant proceeds is used to determine depreciation or other subsequent accounting for the asset. The deferred income approach recognizes a grant on the balance sheet as deferred income and in earnings on a systematic and rational basis over the periods in which the entity recognizes as expenses the related costs for which the government grant is intended to compensate. The grant is presented on the balance sheet as deferred income and presented on the income statement as either 1, separate under a general heading such as other income, or 2, deducted from the related expense. Next slide, please. A grant related to income is a government grant other than a grant related to an asset. For example, a grant that reimburses a business entity for operating expenses. Similar to a grant related to an asset, a business entity should not recognize a grant related to an income until it is probable that 1, the business entity will comply with the conditions attached to the grant, and 2, the grant will be received. In addition, an entity must incur the related expenses for which the grant is intended to compensate. A grant related to income should be recognized in earnings on a systematic and rational basis over the periods in which the entity recognizes as expenses the related costs for which the grant is intended to compensate. Consistent with the grant related to an asset accounted for under the deferred income approach, the grant related to income can be presented either 1, separately under a general heading such as other income, or 2, deducted from the related expense. Next slide, please. There are 3 different transition methods that entities can elect to apply the guidance. The first alternative is a modified prospective approach. Entities would apply the amendments prospectively to 1, government grants that are not complete as of the effective date, and 2, government grants that are entered into on or after the effective date. Under this approach, prior period results should not be restated, and there is no cumulative effect adjustment. For purposes of applying this transition method, a government grant is complete when substantially all the proceeds have been recognized before its effective date. The second alternative is to apply a modified retrospective approach. Entities would apply the amendments retrospectively to 1, government grants that are not complete as of the beginning of the earliest period presented, and 2, government grants that are entered into on or after the earliest period presented. Under this approach, all prior period results should be restated for government grants that are not complete through a cumulative effect adjustment to the opening balance of retained earnings as of the beginning of the earliest period presented. For purposes of applying this transition method, a government grant is complete when substantially all the proceeds have been recognized before the beginning of the earliest period presented. Lastly, the third alternative is a retrospective approach. Entities would apply the amendments retrospectively to all government grants through a cumulative effect adjustment to the opening balance of retained earnings at the beginning of the earliest period presented. For public business entities, the guidance is effective for annual reporting periods beginning after December 15, 2028, and interim reporting periods within those annual reporting periods. all other entities can adopt the amendments 1 year later, and early adoption is permitted. As mentioned, the final ASU will be issued in the fourth quarter of 2025. Now I'll pass it over to Sam to discuss PIK dividends.
Thanks, Christina. Now I'm going to discuss the initial measurement of paid in kind or PIK dividends on preferred stock. So how did this project come about? Well, it came up from an emerging issues task force agenda request. There is currently no gap on the initial measurement of PIK dividends on equity classified preferred stock, which has resulted in some diversity in practice. The goal of this project is to create a gap to address this issue. Both public and private companies issue preferred stock instruments with dividends that may be paid in kind. However, it is more common for private companies to issue preferred stock with paid in kind dividend features, which is why we thought it was important to speak about this project today. This project is not expected to impact not-for-profits. And I'm going to advance to the next slide here, which is about proposed amendments. The proposed amendments will apply to all entities that pay dividends on in-kind on equity classified preferred stock. The proposed ASU was issued a couple months ago, September 30th, 2025, and the comment period ended just a couple weeks ago, October 27th, 2025. For the instrument scope, the proposed ASU would be applied to paid in-kind dividends on equity classified preferred stock. Equity classified preferred stock includes preferred stock that is classified as permanent or temporary equity. The board has decided that PIK dividends would initially be measured on the PIK dividend rate stated in the preferred stock agreement. For example, if a preferred stock agreement specifies that PIK dividends are calculated by multiplying the PIK dividend rate by the liquidation value of the preferred stock outstanding, an entity would initially measure the PIK dividend at that amount. The proposed amendments would be applied of one of two ways. The first way is on a prospective basis to the issuance of PIK dividends on or after the initial application date. The board also decided to give entities the option to apply the proposed amendments on a modified retrospective basis for equity classified preferred stock instruments that are outstanding as of the initial application date. That retrospective application would occur through a cumulative effect adjustment to the opening balance of retained earnings as of the beginning of the earliest period presented. Early adoption will be permitted as of the beginning of the annual reporting period of adoption. Now, the comment period on these proposed amendments ended just a few weeks ago, so stay tuned for board redeliberations in the future. And now I am going to pass it back over for another polling question.
Right, I'm going to take this one. So polling question 8 is, will the proposed amendments on how an issuer should initially measure paid in kind dividends affect your organization or those you audit? So this is what Sam just covered. A, yes, B, no, C, maybe, or D, not applicable. And while we wait for those results to come in, we did receive a question on software that I want to cover. So the question was whether there are any early indications of whether companies think the adoption of ASU 2025-06 or the targeted improvements to internal use software will typically result in more or less capitalization. Based on the feedback that we've received, we expect that capitalization generally will not change significantly for most types of internal use software. However, for the development of software to be provided via a cloud computing arrangement or a CCA, the board does expect that the amendments could result in a decrease in those types of costs. At about 92%, so we'll give you a few more seconds here. The results are in. We've got 38% not applicable, 36% no, and a very small percentage saying yes, 7%. So with that, I think I turn it back over to Christina.
Thank you, Ashley. Next up, I will discuss the Accounting for Debt Exchanges project. The project was recommended to the board from the EITF. Specifically, the EITF recommended that the board specify that exchanges of debt instruments that meet certain requirements should be accounted for by the debtor as the issuance of a new debt obligation and an extinguishment of the existing debt obligation. Under current GAAP, when an entity modifies an existing debt instrument or exchanges debt instruments, the entity is required to determine whether the transaction should be accounted for as a modification of the existing debt obligation or the issuance of a new debt obligation and an extinguishment of the existing debt obligation. Stakeholders have noted current practice does not reflect the economics of debt exchanges. The 10% cash flow test is challenging to perform, and there is significant diversity in practice. A proposed ASU was issued in April, and in September, the board completed redeliberations on this topic. A final ASU is expected in the first quarter of 2026. Next slide, please. In terms of the scope, the guidance applies to exchanges of debt instruments where the new debt issuance has multiple creditors. Many comment letter respondents supported expanding the scope to also apply to transactions with a single creditor in the new debt instrument. In making that decision, the board noted that comment letter feedback was generally aligned with the issues identified and discussed during initial deliberations. However, the board considered that the proposal is intended to address issues in exchanges with multiple creditors and decided to affirm the proposed scope. There are two conditions to qualify for the new guidance. The first is that the existing debt instrument is repaid at its contractual terms or repurchased at market terms. The second condition is that the new debt instrument is issued at the market terms. The proposed ASU included an additional requirement that the new debt instrument was issued following the entity's customary marketing processes. Comment letter respondents raised many issues about assessing customary marketing processes, so after considering the feedback, the board decided to remove the proposed requirement. Next slide, please. The final amendments will be effective for all entities for annual reporting periods beginning after December 15, 2026, and interim reporting periods within those annual reporting periods. The final amendments are required to be applied prospectively to exchanges of debt instruments that occur on or after the initial date of application, with early adoption permitted. Additionally, an entity is required to disclose the nature of and reason for the change in accounting principle in the period of adoption. Early adoption of the amendments is permitted as of the beginning of an annual or interim reporting period. As mentioned, a final ASU is expected in the first quarter of 2026. With that, we will turn it over to the next polling question.
Thanks, Christina. Okay, this is polling question number 9, and we only have 10 of them, and you need 8 of 10 to get your full CPE credit in addition to the required number of minutes. So please respond to this. Do you think that the proposed amendments on accounting for debt exchanges will affect private companies or not-for-profit entities? A, it will affect most private companies and not-for-profits. B, it'll affect some private companies and not-for-profits. C, very few will be affected. And D, not sure. As we are waiting for folks to respond, are there any questions in the queue that speakers would like to address at this time?
Hey, Jennifer, I'll jump in. I received a question about where one can find exposure drafts and ITCs. You can find these a couple places on our website. First, you can find them off the homepage, and second, you can find them on the project-specific pages. So just go up under projects, and you can also subscribe to the mailing list as well, so you can stay up to date.
Great. Thanks, Jack. So we're right around just over 90%. Give folks a few more seconds here to respond. Okay, with that, I'm going to close out that polling question. And it looks like some private companies and not-for-profit entities will be effective. Was 40% of the responses. So with that, Jack, I'm going to turn it over to you to talk about digital assets. And you're on mute, Jack.
Tough day. Next, I will discuss one of our recently issued standards, digital assets. And to give you an overview of the standards history, in December 2023, the FASB issued crypto-specific guidance, ASU 2023-08. This guidance became effective for all entities this year, specifically for fiscal years beginning after December 15th, 2024, including interim periods within those years. Early adoption was previously permitted. Now, assets that meet the following criteria are in the scope of 35060. They do not provide the asset holder with enforceable rights to or claims on underlying goods, services, or other assets. They are created or reside on a distributed ledger based on blockchain or similar technology. They are secured through cryptography. They're fungible, and they are not created or issued by the reporting entity or its related parties. This standard addresses the subsequent measure and disclosure of in-scope crypto assets. Next slide. So, the research project that I previously mentioned on digital assets was added in August 2025 in response to stakeholder feedback. The agenda consultation included a question on the challenges in applying current guidance on crypto asset transactions. We had 31 stakeholders provide feedback, including the following areas: asset classification of certain stablecoins, which, by the way, the board has added as a project a couple of weeks ago; derecognition accounting for certain transfers of crypto assets; measurement of wrapped coins or other crypto assets excluded from 35060. Those two items will be discussed this Wednesday. Accounting for tokenized real-world assets, token issuer accounting, and gross versus net presentation for intermediaries for certain crypto transactions. The board has also received a request on accounting for liquid staking tokens and tokenized real-world assets. Next slide. All right. Now I'm going to touch on some recent regulatory developments in the U.S. that have brought digital assets to the forefront once again. First of all, there's the Genius Act that became law on July 18, 2025. It defines payment stablecoins, sets criteria for an entity to become a permitted payment stablecoin issuer, includes redemption and reserve asset requirements, and sets criteria for digital asset service, such as custody providers. Importantly, that act also clarifies that a payment stablecoin that is not issued by a permitted payment stablecoin issuer may not be treated as a cash or cash equivalent for accounting or other purposes. All right, next we have the SEC Crypto Task Force that seeks to clarify the application of federal securities laws to the crypto asset market and to recommend practical policy measures. The SEC and its staff are accepting written input and holds meetings with stakeholders on regulation for crypto assets. And of course, we are monitoring those developments and we'll follow up if there are any that are related to accounting standard setting. Finally, the President's Working Group on Digital Asset Markets issued a report to the President recommending regulatory and legislative proposals related to crypto assets. And the report includes recommendations for key areas for the FASB to consider for further consultation through public engagement. Those include recognition and derecognition, issuer accounting, and whether stablecoins qualify as cash equivalents under US GAAP. All right, let's move on to 68. So the classification of certain digital assets as cash equivalents, I mentioned this a couple minutes ago. It was a project added to the technical agenda in October 2025. Its whole point is to clarify whether certain digital assets may be classified as cash equivalents. And based on the direction provided by the board, the staff's going to perform additional research and outreach on alternatives to address the classification of certain digital assets. It's going to further understand certain characteristics in describing the digital assets and the scope of the project, such as collateralization, redemption rights, and value stability. And it will be discussed at a future meeting.
So Jeff, I think you're going to talk about intangibles.
All right.
Yep. As soon as I get this camera on. Okay. Let's see. Hold on. Okay. So yes, Jen, I'm going to talk about the intangibles research project, which Jack briefly touched upon earlier. The project evolved based on feedback that we had in the 2021 agenda consultation, which led to a research project focused on software costs, internally generated intangibles, and research and development, or R&D. Then in 2022, the board decided to break out the software cost portion of the project into its own technical agenda project, which was recently finalized in ASU 2025-06, which Ashley reviewed earlier. As Jack mentioned, in December 2024, the FASB issued an invitation to comment, or ITC, to solicit feedback from stakeholders on whether the board should pursue a project on the recognition of intangibles. The board received 43 comment letters from stakeholders in response to that ITC. And recently in September, the board met to discuss stakeholder feedback received on the ITC. The board provided the staff with areas on which to focus research efforts, including R&D, specifically the types of transactions and activities that are considered R&D and disclosures related to R&D. Let's move on to the next slide. Under current GAAP, the recognition of an intangible can vary based on the nature of the intangible. Some intangibles are expensed as incurred, while others may be capitalized. For example, R&D and internally generated intangible assets are expensed as incurred, while intangible assets that are acquired in a business combination are generally capitalized. Let's move on to the next slide. Through the ITC, the FASB staff solicited broad stakeholder feedback on whether the board should pursue a project on intangibles. Specifically, the board wanted to understand a few things here. First, whether there is a pervasive need to improve GAAP related to the accounting for and disclosure of intangibles. Secondly, what types of intangibles should the FASB address? Third, what potential solutions should the FASB consider? Fourth, whether the accounting for intangibles should differ based on how the intangible is obtained. And fifth, what information investors use for their analyses and how that information influences their decisions. As mentioned previously, the staff summarized the feedback and presented that feedback to the board in September. And on the next slide, I'll discuss the key takeaways from the comments we received. And now we're on to that slide. The main takeaway from the feedback that we received from the ITC is that stakeholder views on intangibles continue to be diverse. Consistent with feedback that we've heard in the past, comment letter respondents, provided mixed views on whether the board should undertake a project in this area, and if so, what types of intangibles should be addressed and how the issues should be resolved. Only one respondent supported a broad reconsideration of the accounting for intangibles, and likewise, there was minimal support for a project on the recognition of internally developed intangibles. Most respondents provided feedback on whether and how the board should align the recognition criteria for intangibles acquired in a business combination, acquired in an asset acquisition, or internally developed. However, maybe not surprisingly, their views were mixed on whether the board should align the recognition criteria, and if so, what should be done. In addition, several respondents suggested that the board consider enhancing the disclosures related to internally developed intangibles and R&D. Again, based on the board feedback, on the feedback the board provided, the staff will be focusing research efforts, especially on the scope and disclosures around R&D. And with that, I'll turn it back over to Jen for our next polling question.
Yes, this is polling question number 10, and this is the final polling question. And it asks, which area of the webcast did you most benefit from learning about thus far? There are a lot of choices here. A, the FASB's current agenda. B, post-implementation review activities. C, private company council activities. D, not-for-profit advisory committee activities. E, recently issued and forthcoming accounting standards updates. F, research projects, and the other option is other. While we're waiting for folks to respond, are there any questions that speakers can respond to at this time? Oh, you guys are fast. We've already got 88% of you who have responded to the polling question. Again, please get your responses in. And we do it, so it's 2:55 Eastern on my clock, and we will attempt to go to 3:05 p.m. on this webcast. And so, we've got about 10 minutes left. Okay, we have 92% of you who have responded. So with that, I think we can go ahead and close this poll out. Okay, it looks like we have some the winner is recently issued and forthcoming ASUs. So thank you for your responses to that polling question. And now I'm going to turn it over to Sam.
Thank you, Jennifer. So there's one more topic that we're going to take a deep dive into, and it is our research project on financial key performance indicators, also known as KPIs, which I'll be using as shorthand for the rest of this topic. These are specifically focused on those KPIs for business entities. This research project was started to explore how pervasive the perceived issues around financial KPIs are and whether technically feasible solutions exist. For the purpose of the FASB staff's research, a financial KPI is a financial measure that is calculated or derived from the financial statements and related accounting records that is not part of GAAP financial statements already. Some examples of financial KPIs include EBITDA, free cash flow, organic sales growth, return on assets, just to name a few, and there's plenty others that meet that definition. KPIs do not include financial statement performance measures, totals, or subtotals. They also do not include non-financial KPIs that incorporate information from outside of an entity's financial statements, such as churn or same-store sales. The FASB staff issued an invitation to comment on financial KPIs in November of last year, and comments were due 6 months after that in April of this year. One item to note here is that the ITC is specific to financial KPIs for business entities, as I mentioned before. Therefore, this project does not apply to NFP organizations. Now, we'll discuss what was in the 2024 invitation to comment. I'm going to advance the slide so we can all follow along. So, what did that ITC contain? It contained two main questions that the staff sought input on. The first was what should be the relative priority of a project of financial KPIs, and the second was an ask on how pervasive and comparable those KPIs are. So this ITC contains two potential approaches for standard setting on KPIs. First, the FASB could define commonly used financial KPIs such as EBITDA, free cash flow, maybe some of those others that I mentioned before. FASB could also require or permit those measures to be disclosed in the financial statements. The staff notes that defining commonly used financial KPIs would not prohibit a company from making adjustments to those defined KPIs. So for example, if the FASB defined EBITDA, a company could still use adjusted EBITDA as a way to tell the company's story in an earnings release similar to how they do it today. The ITC also explored incremental disclosures. For example, the identification of financial statement line items where components of those financial KPIs are included could be disclosed. The other approach would be to require or permit disclosures of financial KPIs that management presents outside of the financial statements, in the notes of financial statements. Again, the ITC also explored incremental disclosures. For example, a reconciliation to the most comparable GAAP and identification of financial statement line items where components of financial KPIs are included. Next, we're going to discuss the feedback and the next steps from that ITC. The first approach in the ITC, which would define or standardize certain commonly used KPIs, had mixed feedback in terms of the potential benefits of standardizing these measures, with more respondents indicating that there would be no benefit. EBITDA free cash flow, and current ratio were the most common suggestions for gap-defined KPIs. The last main feedback point on the first approach was that many said that disclosure of defined measures should be optional and not be required if the FASB were to standard set in this area. Moving on, many conveyed a lack of support for approach 2. The reason for this lack of support being that it would bring management-defined KPIs into the GAAP financial statements, and the concern was focused on operability, auditability, and the potential costs associated with this approach, while providing minimal incremental benefits to investors. On the other hand, some indicated that this approach would increase the reliability of measures that would be presented in the financial statements. The board met in late September to discuss the feedback received from the 2024 ITC that we have talked about so far. The board had mixed views about the direction of this project and made no decisions. Some board members agreed with much of the feedback heard on approach 2 that confirmed it was likely not a technically feasible solution, nor a cost-beneficial approach to the topic. The board provided suggestions and observations about the focus of the project and prioritization for continued research efforts. With that, I am going to hand it back over to Jack, who will take on our last topic.
Great. Next slide, please. All right, so I'm going to take you a little bit through this slide here. First of all, I'd like to talk about the statement of cash flows. This is where I stumbled earlier, and I wanted to make sure I got this clarified. The goal of the project on the board's agenda, targeted improvement statement of cash flows, is to make targeted improvement to the statement of cash flows in relation to the activities of financial institution and information about cash interest received. This is a presentation and disclosure focused project. Financial institution preparers and investors have said that many of the activities of a non-financial institution that are classified as investing or financing are operating activities of a financial institution. Separately, the FASB chair has also added a project about the statement of cash flows on the research agenda to more broadly explore potential improvements for non-financial institutions. And that board has not added that broader project to its technical agenda. So I hope that helps. All right, let's go back to the top and talk a little bit about environmental credits. The objective of the environmental credits project is the accounting and disclosure for environmental credits and environmental credit obligations. It was added to the technical agenda in May 2022. The board issued a proposed ASU in December 2024. The comments were due in April 2025, and a final ASU is expected later this year or early next year. Stakeholders noted that entities are increasingly subject to additional government mandates and regulatory compliance programs related to emissions, which often result in obligations that may be settled with environmental credits. Stakeholders emphasize that GAAP does not provide specific authoritative guidance on how to recognize and measure environmental credits or the related obligations that result from regulatory compliance programs. As a result, entities typically account for environmental credits and environmental credit obligations by analogy to inventory, intangibles, or contingencies. Let's talk about the proposed amendments. An entity would be required to recognize an environmental credit as an asset when it is probable that the environmental credit will be used to settle an environmental credit obligation or transferred to another party in an exchange transaction. An entity would be required to recognize costs to obtain all other environmental credits as an expense when incurred. This would include entities that voluntarily commit to reducing their emissions by a future date, so-called net zero or carbon neutral initiatives, and that use environmental credits to partially offset their emissions. Those will all be expensed. an entity would be required to recognize an environmental credit obligation liability when events, for example, emissions occurring on or before the reporting date result in an environmental credit obligation. In determining whether liability should be recognized, the amendments in this proposed update would require that an entity assume the reporting date is at the end of the compliance period, or regardless of whether the compliance period ends on that date. During an August 2025 meeting, the board discussed the feedback on the issue and completed its redeliberations, and a final standard is being drafted. Let's move on to accounting for equity method investments. This was recently added to the agenda. It was first discussed on November 12th. During the November board meeting, the board decided that the scope of the project will be to address the accounting for a subset of equity method investments in partnerships and similar entities for which the investor is unable to significantly influence the operating and financial policies of the investee, and to clarify how equity method investors in non-real estate entities should determine equity in earnings for investees with complex allocation structures. Codification improvements is an evergreen project where stakeholders have provided feedback on minor corrections and clarifications using our codification research system feedback mechanism, or otherwise communicating to the staff or the board. This is a perpetual project, and this is a periodic update. During a July 2025 meeting, the board discussed feedback on the most recently issued proposed ASU on codification improvements and completed its redeliberation, and we're expecting to get a final ASU out by the end of the year. Interim reporting. Its objective is to improve the guidance in topic 270 by clarifying the guidance in that topic is applicable and to improve the navigability of required interim disclosures. It clarifies that topic 270 applies to all entities that provide interim financial statements and notes in accordance with GAAP. And the key there for private companies is whether or not you provide interim financial statements and notes in accordance with GAAP. It creates a comprehensive list and a principle. And this document also is expected out by the end of the year. Topic 815 on hedge accounting improvements. This addresses a list of targeted improvements, hedging forecasted interest payments on choose-your-rate debt, cash flow hedges on non-financial forecasted transactions, and foreign currency denominated debt as a hedging instrument and as a hedge item, a so-called dual hedge. And the final ASU is almost complete and expected out by the end of the year. The EITF has received requests on a couple of new issues, one related to market return cash balance plans and mortgage servicing rights. And I think we have one more that the EITF is going to consider that you can find out on the website. So, Jennifer, I think that concludes our prepared remarks today.
Great, Jack. Thank you for doing what I call that lightning round of updates on other selected projects. So with that, we are at 3:08 p.m. Eastern, and we appreciate your time and attention today and for joining the webcast. And again, if you'd like to keep up to date on FASB activities, you can subscribe to our action alerts. So with that today concludes today's webcast. Thank you.